Hello and welcome to Money Control. Just two more trading sessions before the final day of the verdict on June 4th. How do the markets react to June 4th results? What is the market really discounting for the June 4th? We have two marquee guests today, Pramod Gubbi from Marcellus Investment Managers and Jigar Mistry. Thank you, Jigar, Pramod, both of you for joining me this morning.
Thanks, Sonal, for inviting us.
First off, last 2 days, we've seen some sort of a pullback. From May 9th, we've had a one-way street. Markets have just gone up, up and up. Is this just some last-minute nervousness that was inevitable? Is the market sort of discounting a status quo, or do you think otherwise? Jigar, you want to go first?
Yeah, sure. So I think, some amount of nervousness getting into sort of election results is par for the course, right? You look at the amount of seats that get decided on a minuscule vote, that's quite large. Like if I look at Bengal, just sort of West Bengal, just 4% vote swing can shift something like 12 seats in either directions. And with so many seats being decided at the margin, I think no amount of pre-poll, post-poll sort of analysis is going to tell us the final picture. In the process, I think what we have seen is the net open positions for FIs until I think yesterday was squared out. Market positioning, from what we understand, is quite light getting into it. We have had a stellar rally until October, November 23. I think the markets were broadly in line. But since then, Fed appearing to pivot sooner than expected in November, and then BJP winning those 3 state elections in December, I think has catapulted India's market into a trajectory of its own. And that has resulted in a stellar performance. And it's only sort of par for the course that we expect some amount of pullback and reversal of things as we run into the final day of polling and the sort of exit polls that get announced on the 1st of June.
Sure. So everybody accepts it's hard to predict the verdict. Jigar also pointed to the margins, the vote cap is so small in so many constituencies that it's very difficult to predict. But is it equally difficult or more difficult to predict the market reaction to these outcomes, Jigar?
Yes, I guess.
That is an easier ask, so please take a shot at that.
Yeah, numbers ML are easier to predict than the human psychology, right? So, yes, so I'm with Pramod, right? Eventually over the long term, earnings do drive, the stock markets. But in the medium term, I think something which is the combination of earnings plus the re-rating or de-rating of the PE multiples, right? So if you look at sort of the larger caps in India, the index is up something like 50%. The earnings are up 40%. So PE has re-rated by about 10 percentage points worth of the market performance. But if you look at the same picture for small and mid caps in particular, those variations are large. So if I look at the small cap index per se, which I'm using SEBI classification, which is companies number 250 to 500, or rather 251 to 500, that gap is meaningful. The index is up something like 70% over the last year, whereas earnings are up something like 20%. And the same number for micro cap is even more stellar. 90% market valuations up, earnings up only about 5 to 7%. And therefore, when you ask that question, that how the market reaction will be, depends a lot more on what kind of the market you are looking at. For larger caps, I think if there was an outcome where BJP plus NDA are not even able to secure a majority of 272, then I think the corrections in the small and micro cap space will be sort of very, very sharp. You could see the valuations, at least the ones that has been re-rating, completely reverse and get into a de-rating trajectory. So earnings could continue to grow at a reasonable speed, but the share price movement could be quite wild. On the other hand, larger caps may not move as much, and therefore, your incremental money could flow there, and that might be a better place to be. If there is a scenario where they get more than 272 comfortably or thereabouts, if it's thereabouts, then the immediate reaction on the market may not be one of celebration. If they get there comfortably, NDA crossing 340.50, then I think people will assume that foreign inflow will come to India, right? You look at $3.5 trillion economy going to five, and you look sort of beyond that. What all countries do we have? We have Brazil at roughly around $1.5 trillion, but that's all commodities. You have Saudi, which is $1 trillion. That's all oil. So incrementally in the growing world, a country with a strong sort of democracy, vibrant judiciary, consumption market, which are large, foreign inflows will flow into India. Domestic savings, as we are seeing, is already flowing into India. So over the longer term, I think things would still be okay. But in the nearer term, if BJP plus NDA doesn't really sort of is able to secure at least 272, then it's going to be a much more difficult run up to the longer term.
Sure. So two key takeaways. The first point you're making is that small caps will see a sharper markdown, considering the fact that they have overshot, or they've also beaten the frontline companies over the last year or so. But why should this be the case? Of course, you can argue that valuations are stretched and therefore the pullback has to be sharper. But what has that got to do with the government?
It's the flow, Mahalakshmi. So let me put it in two other statistical formats. Let's say if you look at the micro cap companies per se, which is company number 501 on the market cap list, going all the way down, there are total 3,250 companies in this bucket. At COVID low, the combined market cap of this segment was 5 trillion INR, so 5 lakh crores in colloquial terms. If you compare that number today, that's upwards of 32 lakh crores. Now, if you look at who owns this space, that's essentially retail. Retail owns 49% directly in the free float for these companies as a cohort, and 20 more percent through mutual funds. So imagine the kind of wealth that has been generated in the past 4 years because of this. 10 odd lakh crores, if you sort of add it up just in the micro cap space, there is an equal and higher number in the small cap space, which is another, say, 10 to 12 lakh crores. So 22 odd lakh crores is the wealth that is created just in the past 4 years. And that entire money has been redeployed into indices and sectors which are just running through because of low free float. So if you look at the 365 companies that have more than doubled in just the past year, 80% of them are small caps. Now, when you further look into it, you will find that companies with free float lesser than 10% have had the highest amount of increase. And as you keep going down the free float line, or as you keep increasing the free float, the gains come down, and more of this money has been parked into small cap mutual funds. So if you look at just the number of folios, they have quadrupled in under 3 years for small cap funds. And small cap number of folios are now higher than larger cap and the mid cap funds. So when you combine all of this, you realize that a lot of money has been made. That money has been rechanneled in the past 4 years into the same stocks, which has resulted in the valuation re-rating that we have seen. And that's on the basis of an assumption that there is continuity in everything that we are seeing, right? There is no new tax policy. There is no new policy with regards to how capital gains, FNO, etc. is treated, and the party goes on. If now we are questioning whether the party goes on or not, then we are going to see some amount of reversals, because had this been backed by earnings growth, you could have seen a lot more sort of stability to the downturn and the reverse effect of free float not being countered. But that's not really the case from the numbers that we are seeing. It's just a lot of market exuberance and lower free float driving this. And therefore, if the government is at the center is suggesting a change in stance, then I think that reversal of what we have seen in the past 4 years is, again, as I say, par for the course.
So what you are saying is that a negative outcome on June 4th, or anything less than 272 for NDA, which of course looks like a very unlikely scenario right now, but we are just talking about what is an outlier scenario, will change retail sentiment considerably, which therefore will have a bearing, which means that retail investors who've been really the bedrock of this market and supported market at every low, and this whole buy on dip sort of strategy which has supported most stocks, will go on the reverse, and that will create a precipitated fall in small caps. Is that what you're saying?
Yes, absolutely. And another data point to back that up and a policy action, right? So in 2022, when you saw the global interest rates go up by quite a margin, you realize that the Nasdaq in the calendar year 2022 had fallen 35%. And with higher interest rates, right, what typically happens is that foreign institutional investors sell what's considered risky, which includes emerging markets, which includes India. Now, in that scenario, they were selling everything, and sort of the Indian markets didn't fall as much. The reason which you mentioned was that a lot of domestic money was coming in, and that supported the Indian markets. Now, part of the reason, at least in my opinion, why this money started to flow in was because of the actions that were taken by this government in terms of how they are looking at formalizing the economy. Right, Demon, although I think this government also has stopped mentioning that, but that led to the surprise, the negative surprise that anything could happen, and therefore the intention to curb the black money was laid down. And then with GST flowing in, a large amount of unorganized economy came into the organized markets. And therefore, that started a chain reaction that made, say, real estate and gold a lot less attractive asset. And it also made basically the, equities where the historical ownership is much lower as a lot more interesting market. Now, if the alternative to this government comes through and publicly they have sort of decried everything from DMON to how GST has been implemented, and if they want to get into a policy action which is counter opposite to what we have seen over the past 10 years, then it suffices to say that then domestic is not here to support the market. And sort of globally, we still think that we are in the race for higher for longer in the interest rate cycle. And in that scenario, sort of everything goes for a toss in that manner.
Jigar, that's not a very pretty picture. Let's not go there. How about you, Jigar?
Yeah, I agree with Pramod. We may have very well borrowed some returns from the future. And therefore, even if you get sort of a reasonably good government, the first initial reaction could still be one of, a laid back attitude where you want to see what really transpires. And I think the thing that I am keeping an eye out on, Mahalakshmi, is the fact that you look at the increasing sort of decibel levels across, the agencies. So if you look at what RBI has done, followed by the SEBI chairman, making some announcement, followed by the finance minister herself announcing this, I think they may have been a little bit worried about how the past 6-7 years, a large part of incremental sort of lending from the bank side has gone into personal loans, both secured and unsecured. The number is as high as 80% of the incremental lending. Now, part of this money may have gone to the gaming industry, including sort of the cricket and all those analogies that you see on the IPL. As well as part of it may have flown to, the F&O markets into India. Now, if I look at RBI action, they reverted back to the risk weightages to make sure that part of this is curbed. We have already seen the GST impact being taken on the gaming companies. But so far, there have only been pronouncements or at least statement of intents both by SEBI chairman and the finance minister on where they want to take this whole sort of excessive build out. You've never seen the market ratios of cash to F&O that you see in India in any other emerging or developed market. So if that is something they want an orderly wind down eventually, and they take some action to sort of be the villain in the shorter term so that they become the hero in the longer term, now that's something that we need to watch out that could burst the exuberance. And otherwise, every now and again, you've seen these rallies only needing, if they are sort of exuberant, you only need a superfluous reason for them to deflate. Like in 2016-17, we had a great rally in small and mid caps, but 2018, we had the long-term capital gains in Feb, and then some SEBI realignment for mutual funds, which was a flow issue and not a fundamental issue. But from the highs of Jan 2018 to middle of August 2019, you saw some 48 companies correct 80% or more, and 250 companies correct more than 60%. So whatever is unsustainable in the market eventually finds a way to topple down by its own way. And I think something like that could very well happen. Over the longer term, I'm with Pramod. India, great demography, great flows. But over the shorter term, we may have very well sort of borrowed some returns from the future.
Sure. So now coming to portfolio positioning, Jigar, do you use any hedge and stuff like that for an event risk like this? And this time, of course, you are more bullish. So are you using anything?
No, not really. See, eventually what typically happens, Mahalakshmi, is that we run sort of an alternative investment desk, which is a PMS and an AIF. And theoretically, we are allowed to use sort of an option to guard the downside. But what ends up happening is that, the volatility, the implied volatility is in the protection that you seek to take goes up. And then immediately post-event, that deflates in quite a hurry. So you may well have this positioning where you are only protecting a time cover. The impact turns adverse, but the portfolio is not protected and you end up spending 2-3% of your capital in trying to protect your portfolio. Very similar to the operation is successful, but the patient is still dead kind of an analogy, right? So the better way sort of we have found to deal with market uncertainties is, trying to manage the beta of the portfolio rather than trying either to cash in or cash out of the portfolio. So adjusting the cash flows or adjusting essentially the protection bit. So if you look at our beta positioning in the months of August 22 to March 23, where we were dialing up our small cap exposure, the beta positioning for us was upwards of 1.35 times, which in today's circumstances is down to 0.4 times. Our portfolio, which was almost 60% small and mid cap, because we run only one strategy. So that's the be all and end all, which was almost 60% small and mid caps in March 2023, is today completely flipped around to larger caps. We are at almost 55%. Large caps, 25% sort of higher end of the mid caps, and only 25% smaller caps. So we don't really either believe in timing or hedging, but adjusting the beta of the portfolio.
Understood. Jigar, now there is this, 1 lakh crore extra bounty that has come in from the RBI, which is going to be, which is something the government may not have accounted for. It definitely didn't account for it in the last budget. So where does this go? I mean, people are naturally expecting that, either they will go for, the two options, either you go for aggressive fiscal consolidation or you step up public investments even more to ensure that, you provide more growth momentum. Do you think there is a third way?
Yeah, reduce taxes.
Yeah. Expound on that.
Yeah.
And I ask that because, if that were to happen, will the complexion of the market and the lay of the land today change completely? Because right now, momentum areas are everything related to infrastructure, economy sensitive, so to speak, cyclicals that are coming off the lows, banks which will, write those credits, etc. Could that move into an consumption basket, and some of it, I think Pramod has been at the receiving end of some of your portfolio stocks have not performed because of that. Could that change completely if this were to happen?
Yeah, see, so I think if you look at how the entire gross fixed capital formation in India is progressing, we are actually at the precipice of something big there, right? So if you look at the GFCF, especially in comparison to GDP, there was one cycle which happened over 2012 to 2021, where the last years of Manmohan government and the first few years of Modi government were not really too keen on getting this rolling, and then the asset quality review was stepped up by the RBI, which essentially resulted in the GFCF to GDP sort of sharply slowing down after a very strong up move from 2002 to 2012, right? So sort of that was one phase. There was a second phase which brought it down. And now from 2021 across the board, so there are four components to GFCF: your central government spending, state government spending, private corporation spending, and your real estate and housing. And across all four of these pillars, we are now seeing sort of a run which has been unprecedented. Your central government spending has gone up from 6.5 to close to 11.5 lakh crores. State governments, which typically used to be 1.2 times your central government, had slowed down after COVID. That's now come back. And if you look at private corporation spending and using listed entities as a sort of sample for that, then their capex has gone up to almost 7 lakh crores or 7 trillion, which is the all-time high that at least the data that we are tracking, and real estate and housing is doing fairly well. So I think what the government tried to push through in terms of, getting the ball rolling on capex, I think that ball is now started rolling, and any incremental number either through tax buoyancy that they get or the incremental RBI dividend that they may or may not have accounted for can actually go down to bring the tax compliance lower, especially the places that they want to stimulate. At least in that instance, I think increasing the disposable incomes in the hands of a few taxpayers or using those for, the housing scheme. Because I think if you look at the rhetoric around this election as well, unemployment and sort of housing is becoming an issue. So I think in terms of portfolio tilt, we are sort of pushing this to corporate banks because those are the ones that are likely to see the growth in terms of lending. We are also increasing exposure to housing finance companies because that's another place which we think they might use this. And lastly, I think sort of the consumption businesses, not staples per se, because I think the absolute lower end of the strata is still not completely recovered. But I think to a slightly higher end, which premiumizes, I think those could be good places to be at.
As I'm just throwing this question at you, Jigar, just tell us what are your top 3 bets, and Pramod, if you can also give us your top 3 bets at this point in time.
Right, so I'll sort of have the first go at this. So as I mentioned, Mahalakshmi, corporate sort of facing banks are our first go. As I explained, GFCF to GDP has now sort of turned around. Last decade was all about, all these consumption-based entities because 80% of the incremental lending was going to PL. Given that I expect some sort of policy action on curbing that down and the GFCF to GDP incrementally going into lending part of it as well, I think corporate-facing banks is one place which we have tilted to. The second space which I mentioned was housing finance companies. Clearly, that's one space which will call for a lot of policy actions, and that's where we are at. The third place, I think, is telecom is looking increasingly interesting. We have had a reasonably large exposure there. But I think if you look at the place in terms of competitive intensity, we think we may have peaked there. Indian companies, if you look at their conference calls, want to reach an ARPU of say around 300 rupees, which is roughly $3.5 when converted. Right now, if you look at where that is in relative context, it's the lower end of where the African market is. Right, so Africa is at something like $3 to $7 of ARPU. China is $7 to $11. Europe is 10 to 20. US is upwards of $30. So the ambition of Indian sort of telecom companies is to reach what's the lower end of an African market. Now that's easier said than done because the entire data architecture of Indian sort of ecosystem is based on low data rates. So the rises might be slow and steady to come by. But the direction is broadly clear that you will have to take price increases, given that the competitive intensity is now settled. So I think that's one space. So three areas: corporate banks, housing finance companies, and telecom sort of ecosystem.
Sure. Thank you so much, Pramod, Jigar. Thank you so much for joining me this morning.
Thanks for inviting us again.